The crash of Silicon Valley Bank, known as SVB, on Friday sent shockwaves through the financial markets. There is real concern from investors and depositors that we could be looking at another financial crisis like what we saw in 2008. I want to explain to all of you exactly what happened and let you know how the Silicon Valley Bank crash is substantially different than 2008. But I also want to highlight some issues that are currently going on in the banking industry, which could cause some other issues in the future. For those seeing one of my videos for the first time, my name is Brad Heddick, and I'm one of the principals of a firm called Commercial Lending X, or CLX for short. At CLX, we provide a wide range of commercial financing options for our clients through over 500 plus unique funding partners. And we also have a bank consulting division as well. As a former banker and credit manager myself, I have years of experience in the industry and have looked at billions worth of transactions. So it's with that insight I am providing you details today on the SVB issues. I apologize now that the quality of this video isn't quite what we usually put together, but I wanted to get this information out to you as quickly as possible. Before we dive into specifically what happened with SVB, it's important for you to understand how a bank balance sheet works, as it was SVB's balance sheet that ultimately caused them their issues. Bank balance sheets are very complex, so for this discussion, I'm going to just try to keep it simple and just highlight the top items on the balance sheet. On the asset side, banks primarily have cash on hand, loans, and investments. Although one might think loan is a liability under normal circumstances, since banks originate those loans and are earning interest income on them, they're actually an asset to bankers, not a liability. Investments for banks are typically held in two categories: those held to maturity and those available for sale. And you're going to hear a lot about these two categories in the news over the next couple weeks. For those securities classified as held to maturity, if the value changes on those securities, the bank does not have to report a loss. The reason for that is the bank is going to hold them to maturity, in which case they'll eventually get paid back the principal on those investments. For those investments classified as available for sale, if there is a loss in those securities, the bank must report it right away because they are relying on an immediate potential sale of those securities to generate capital for the bank. Banks must classify upfront how they intend to hold their securities. So banks can't just reclassify their securities on a whim as changes in market value impact them. Under normal market conditions, there's little change in the value of these securities. They're typically treasuries or other high-end bonds where repayment is pretty much guaranteed, and because of that, there's little fluctuation in value. Usually the change in these securities is less than 2%. But because the Federal Reserve has been raising interest rates so quickly and new debt instruments are getting issued at much higher interest rates, the value of these securities held by banks have dropped substantially, and in some cases by as much as 10%. This is very atypical, and it is directly being caused by higher interest rates in the market. Now, quickly going to the liability side of balance sheets, banks' biggest liability is deposits. Deposits are a liability for banks because depositors could choose to spend that money or move it out of the bank at any time. And if deposits leave the bank quickly, it can impact the rest of the bank's balance sheet. And of course, there's bank equity, which is the difference between a bank's assets and liabilities. Oftentimes, they're retained earnings from earnings over the years. And banks have to keep certain equity ratios in order to operate. Banks typically invest a majority of their deposits into loans. As loans, banks earn income on those deposits. And loan interest is the primary source of income for most community and regional banks. Because deposits cost money in the form of money market rates and certificate of deposit rates, banks cannot sit on a huge amount of deposits if they have excess deposits that aren't loaned out. If they did, they lose money on those deposits. So banks put those deposits into equities and investments. So let's talk about SVB's specific situation. SVB at a bank had $209 billion in assets at the end of 2022. On the asset side, they had about $74 billion in loans and about $117 billion in investments, with $91 billion of that in held-to-maturity securities and $26 billion available for sale. On the liability side, the bank had $175 billion in deposits, and the bank had $16 billion in equity. Overall, SVB was a very healthy bank. Their loans were performing well. Less than 0.2% of their loans were past due or non-performing at the end of 2022. And the bank had a loan loss reserve. That's money specifically reserved for potential future losses, just under 0.9%. So over 4 times that wasn't performing. And that would only consider if they lost 100% on those loans not performing. So the bank was fine on their loan portfolio. The bank also had a very low loan-to-deposit ratio. Most community banks have loan-to-deposit ratios that are north of 80%. SVP had a loan-to-deposit ratio of only 42%, meaning in theory, they had plenty of liquidity. SVP had good capital ratios. Their Tier 1 capital ratio was 16.2%, and usually banks want to be north of 12% on their Tier 1 capital ratio. As a general rule, regulators do not get worried about taking banks over unless their capital ratios drop below 4%. So SVP was well above that. And lastly, SVP made money in 2022. Even after reporting losses on securities of about $1.8 billion, the bank made $2 billion in net income in 2002. So you're probably wondering, what happened to SVP? How did it go wrong so fast? On Wednesday the 8th, less than a week ago, SVP sold the securities they had held for sale and took a $1.8 billion loss on those securities. They likely did that because they needed liquidity. As deposit balances fluctuate in the bank, they need cash in the bank in order to allow those customers access to those deposits. Bank management also indicated they plan to redeploy some of that money into higher earning assets like loans or potentially investments at higher interest rates. So rather than continue to hold those investments at lower interest rates, the bank wanted to convert them into assets that would pay more money. At the same time they announced the sale of their investments, they also announced that they planned to raise some capital, and they were looking to raise about $2.25 billion in capital. This was likely to replenish some of the capital loss from the investment sale to keep their capital ratios very strong. However, even after they took the loss on that sale, the ratios were still strong and well above FDIC standards. When the market news came out that not only had SVP taken a loss, but they were also trying to raise capital at the same time, the market panicked. Rather than looking at the health of SVP's overall balance sheet, depositors started to pull their cash out of SVP. Once that started, it continued in droves. This is what is often referred to as a run on a bank, where depositors en masse start to pull their cash out of the bank. At the same time this was happening, the market punished SVP's stock due to that loss, and the stock dropped very quickly. This made it more challenging for SVP to raise additional capital, as they would have had to sell more shares of stock, and the market was now panicked about buying SVP stock. By Friday, within 48 hours, SVP was out of liquidity. They did not have the cash to support deposit operations going forward. That's not that they couldn't eventually get at the cash. They had plenty of securities in the market, but they had burned through their cash very quickly. And the biggest issue they had, the $91 billion held to maturity, they could have started to sell it, but selling it today would have generated additional losses for the bank, and it would have very quickly started to drop their equity position down. I don't think it would have gotten down below the ratios, below the 4% ratio at least that the FDIC doesn't want banks to go below, but it could have dropped it pretty significantly. Before things could get any worse, the regulators stepped in and shut down the bank. It is important to understand that banks do not fail because of bad loans. They fail due to a lack of liquidity, and this is exactly what happened to SVP. This is definitely an issue that could spill over to other banks. The FDIC indicated at the end of 2022 that investment portfolio losses across the entire banking industry that were unrealized were about $620 billion. And that's before considering the impact future rate hikes in 2023 could have on the value of these portfolios. If other banks are forced to sell investment portfolios to create liquidity and then take the associated losses, many more banks could see a decline in their capital to operate. In addition, if depositors get worried about the health of banks that are sitting on large unrealized losses and additional runs start to happen on those banks, you could see this problem start to burn through the entire industry as a whole. If this were to happen, we could see a massive collapse in banking similar to what we saw in 2008. but for a whole different reason. 2008's collapse was due to bad mortgage securities and a damaged mortgage market. It had nothing to do with what's going on today in the equities. However, there are some reasons why what happened to SVB is unique, and I don't think enough people are talking about this. SVB saw huge deposit growth over the past several years. SVB's total deposits were about $50 billion in 2018, and at the end of 22, they were $175 billion. That's a substantial jump in a very short amount of time. SVB was not able to make loans quick enough to match that growth in deposits, so they had a very high percentage of their deposits held in investments, much more than most banks do. In addition, Bloomberg is reporting 93% of SVB's deposits were not FDIC insured. The FDIC insures each business or entity up to $250,000, and payroll accounts are covered for the next payroll period. That means a majority of SVB's deposits were with large depositors. This is not the case for most banks, where deposits are pretty spread out between consumers and small businesses that tend to have much lower deposit levels. Because of the concentration of large depositors who are likely watching SVB's performance much closer due to the risk they had in a lot of unsecured deposits with them, when SVB started to have issues, it moved the needle very fast. However, if the market panics and depositors start pulling cash out of other banks in similar situations, it could cause a cascading effect. Please note, we think a majority of SVB's depositors that did not get their money out in time will likely collect a majority of the money they had on deposit with the bank. Assuming no one steps in to buy the bank in the next 2 weeks, the FDIC usually does a very conservative estimate of what they will recover within about 2 weeks of the bank closure, and will then give those funds out to customers. Since the bank had $91 billion in investments held to maturity, the FDIC can sell those, and there'll be a lot of capital coming back in quickly. Once the bank is fully liquidated, and it will take time to sell or liquidate the $74 billion loan portfolio, whatever is left after costs will go to the remaining depositors. Assuming even a 20% hit on the loan portfolio, which would be a substantial discount on a sale of the portfolio, I would anticipate depositors could eventually recover as much as 90% of what they had on deposit with SVB at time of failure, even if the bank is fully liquidated. Although the failure of SVB has rattled the markets and it will cause harm in the short term, SVB's depositors are not going to lose completely. It is going to impact, though, many businesses that banked with SVB in the short term. SVB is the second largest bank failure ever recorded in the U.S. Many business owners, employees, and businesses that do business with SVB customers are going to be impacted as SVB customers struggle to pay their bills going forward. There are also the stockholders of SVB who are likely completely wiped out at this point. So this is going to have a ripple effect throughout the entire economy. SVB was also a huge backer of the tech industry. It's going to make it harder for tech companies to get the loans and funding going forward. However, the biggest issue I think is going to come out of the SVB collapse is going to be the impact to the rest of the banking industry. Every bank president and CEO is watching closely what happened here. They are all going to be sure their banks maintain plenty of liquidity going forward. This is likely going to lead to a further pullback on lending, as banks want to be sure they have more cash available to support deposits and operations. It may also cause some interest rates to increase as banks look to bring in more capital to be sure they can maintain their liquidity. Although most of the rest of the banking industry is not in the position SVB was, with low loan-to-deposit ratio and high concentration of deposits with a small number of depositors, the fear driven by how quickly a run can happen on a bank is going to make bankers very nervous going forward. If I can give any advice to the rest of the market, do not let panic set in. I've already seen countless articles produced discussing other banks that might have potential capital issues, and those articles have been based on very limited data and have not looked at the overall situation of SVB and compared it to the situation for these other institutions. Keep in mind, many of those banks are in better positions than SVB was, and unless the market forces a run on those banks, most should survive just fine. Again, SVB by all means was a healthy bank. I'm not saying there were not some underlying issues, because there were, with how quick they grew and how they were holding a bunch of their deposits. But the bank was profitable, had good capital ratios, and had a well-performing loan portfolio. It was the market and a run that drove them to fail. Had depositors not pulled out all their cash in mass as quickly as they did, SVB would still be alive today, and they would likely have eventually been able to raise the capital necessary to cover the losses they had from those sales of their investment portfolio. I would encourage anyone to look closely at the financial health of your bank before making any rash moves about pulling all of your cash out of your bank. By doing that, we can all avoid another SVB. And I do plan to produce some information shortly on how you can look at your bank and what key items to look for. Thank you for watching. I hope to bring you more industry news soon, and have a great day.